I'm delighted to be joined on IRTV with Chris Weltzer, Portfolio Manager at Balyasny Asset Management.
Thanks, James. Great to be here.
Thank you for sharing your insights at the latest IR Magazine breakfast briefing in New York, titled Geopolitics and the Economy, What Energy and Industrial Companies Need to Know. Before we have our conversation about those very topical themes, could you introduce Balyasny Asset Management itself, your role at the firm, and the size and the strategy of your team?
Sure. So BAM is a global multi-strategy investment firm with 17 billion of assets under management. We're really focused on bottoms-up, deep fundamental research across equities, commodities, macro, credit, and systematic strategies. I personally am an industrials and materials portfolio manager based in Chicago. I run a large long-short equities book, really focused on covering the entire industrial and materials supply chain top to bottom. I have a team of 9 investment professionals. And then the great thing about the seat is I get to regularly interact with our macro teams, who are really getting in depth into commodities and markets in a way that I'm not able to. So if anything I say ends up being wrong, we'll blame it on them.
Superb. Thank you for your introduction to Balyasny Asset Management. Let's start our conversation by looking at 2 major geopolitical hotspots. What are the top factors impacting supply chains as protests in China have resulted in a loosening of COVID restrictions? And will we still have conflict in Ukraine?
James, yeah, it's a great question. 2 answers. Believe it or not, even after 2 years of a real loosening of the global supply chain and time for the commodity markets to adjust, I'm still hearing about what I call golden screw issues, where a manufacturer is really missing, where 97% of the supply chain is working great, but they're missing that final one critical piece that lets them complete the finished product. Particularly, we still hear that about semiconductors, particularly in the automotive space, things like that, still an issue. On the other hand, the other set of issues companies are dealing with more and more is almost the opposite problem, managing through what I would call the renormalization of the supply chain. Many industries added large amounts of inventory, really at all levels of the supply chain, at the manufacturer level, at the distribution level, because demand was very strong during COVID times, and because the supply chains were very tight and they were worried about just having surety of supply and being able to serve their customers. But now as that supply chain eases, all of a sudden, a lot of the things they've ordered, they're all showing up at the same time. And so companies need to manage destocking and getting to a more normal inventory level as quickly as they can, and getting to a place where production is aligned with demand, but they have to keep customers happy, they have to keep their costs in line, and hopefully realize a lot of the deflation we've seen across the transportation and logistics area, for example.
Indeed. What are the relationships between these geopolitical challenges and the outlook for commodity prices?
Yeah, the geopolitics and commodity prices seem to be intertwined even stronger than they have historically in the last few years with obviously the Ukraine crisis. I think the real lesson from the Ukraine crisis was that generally, if you give the market enough time, as long as the actual raw production of commodity aren't being impacted, markets and trade flows will adjust. We've basically round-tripped a lot of the very large moves we had initially in the commodity markets when the Ukraine invasion actually happened. It took time for the market to adjust. It took time for trade flows to move, but to a large extent, they've adjusted. There are a couple areas where production was actually impacted. So an example would be wheat. Ukrainian wheat production, because of the transportation logistics and just fighting a war in the country, is going to be impacted, is still being impacted. And so you have wheat prices that are still above where they were pre-COVID level. EU gas is the other big example, right? So much irreplaceable infrastructure got knocked out, and a lot of that gas that was flowing has no other means by which to get from Russia to Europe in a a legal, let alone practical way, right? So that's left EU gas prices a lot higher than before the outcome. So when I look forward from here, really it's about whether Russia decides to actually try to weaponize some of its actual production, more so than just selling it to China instead of selling it to Europe. If they were to decide to cut oil production or something like that, that would have a meaningful impact on the supply demand for commodities. And then at the same time, you have the China situation, right, with China reopening. Um, and China is interesting because one of the lenses you can sort of view the zero COVID policy in was China was in some ways sacrificing personal freedom to ensure the industrial supply chain continued to work. You remember all the news of people sleeping in factories in order to isolate and keep production running, keep the factories open. Um, that reverses, you could see a similar situation what we saw in the US, where where demand is strengthening, but the ability to supply that demand is being constantly impacted by component and labor shortages and disruptions caused by COVID.
A lot of variables and felt acutely at many levels too. Speaking of wheat and oil, for the past 6 months, you've been focused on the implications of these risks across energy, agriculture, and freight. Can you provide an overview of how risks in those areas impact supply chains?
Sure. I mean, as I mentioned before, a lot of this initial shortage ended up being solved through basically readjusting trade flows, particularly for energy. Um, Now, when that happens, if we were coming from an area with no constraints, a place with no constraints, everything was flowing as efficiently as possible. Every tanker was taking the shortest route they could. The market was operating as efficiently as it could. So when you introduce these constraints, it makes the system less efficient. And so what you saw in freight, for example, is all of a sudden you have to take oil that used to go from Russia to Europe, a short haul. Now you've got to take it maybe all the way around the Horn of Africa to get to India, or around the other direction to China. And that effectively causes a tightening in the transportation network, because each one of these boats, even though they're carrying the same amount of oil, now has a much longer trip. So you're effectively reducing industry capacity. And that has a very profound impact on the freight markets, first for goods, and now even for things like oil and products. We're seeing that tighten incrementally today as things about the EU price cap come into play, and trade flows are adjusted once again. So it's very dynamic, and we're seeing basically a set of companies that have proven their ability to manage or even take advantage of some of these disruptions, and then others who are having a much harder time and being more reactive.
Chris, what is your attitude toward taking on geopolitical risk in your portfolios?
Yeah, that's a great question. I think you have to look at it in terms similar to how you would look at a stock or something like that. These are not events that are just random coin flips at the end of the day. If you can do the research, if you can talk to the right contacts, and really come up with a firm view on what you think should or might happen, that you feel confident about, or you feel the market is mispricing in some ways, then I treat them as investable events. The example I like to use is in the lead up to the Ukraine invasion. The market was clearly saying, and many experts, some of which former secretaries of defense, et cetera, were saying this is not going to happen. When you ignored what people say and focused on what people do or were doing, you could see the troop build up. And we tried to be creative and sort of get ahead of the situation where we could. For example, we were watching Putin's yachts in various ports around the world, and he had one of his large ones in the port of Hamburg that was being retrofitted. And then one day, about a week before the invasion, it left in the middle of the night. Wasn't finished being completed, just up and left in the middle of the night. And then one of the things I have access to at BAM, which is really fantastic, is again all of these commodity experts who are really tracking every molecule of oil or natural gas by boat. And what we found, we found a boat that was carrying LNG from Russia, originally supposed to go to India, I believe. And in the middle of the night, it goes about halfway there and it turned around. And it turned around and went and anchored offshore of Kaliningrad, which is a landlocked part of Russia, sort of surrounded by Latvia. And it makes you think, why would you do that? You don't really only do that if you were concerned about gas supply within Kaliningrad and keeping your people warm and with energy. And so we were able to put on some trades that would pay off if a war actually broke out, and we ended up being right in that case, and we did. Now there are others where I don't have a view. I can't find a way to form a reasonable view, and in that case, BAM is great because we have the risk tools to be able to basically hedge our portfolio so we're not taking the risks we don't want to take. So for me, it's either consciously do the work, have a view, make an investment, or use the tools I have to sort of neutralize that exposure within my portfolio.
That's a fantastic array of inputs to draw from, and instincts as well, thinking about certain persons' yacht movements. Fascinating. But let me ask you, what risks and impacts aren't you hearing companies discuss?
Yeah, that's another great question. Yeah, obviously everything in the China reopening is moving very quickly. I think a lot quicker than people expected. And at least initially, companies seem focused on the sort of short-term disruptions as COVID spreads across various cities and factories shut down or open up. I think the conversation will eventually move towards, okay, what if China reaccelerates, and what does that mean for inflation? What does that mean for demand for a lot of these key commodities that China is a very large consumer of? I still don't see enough companies talking about what happens if everything I've ordered in my supply chain that was supposed to take 6 months or 9 months to get here suddenly shows up. What do I do? How do I manage it? What do I do with my orders to my suppliers? How do I keep my profitability where it is? What do I do with pricing? There's a whole slew of strategic decisions and tactical decisions that have to come around, that have to be made when something like that happens. The other is, there is real recession risk in the environment today, right? It's not, we're seeing, slightly weaker consumer spending data around the holidays. There's an open question of what things look like in the first half and the second half of next year. And what happens if my backlog that is now at record levels for a lot of industrial companies, for example, because again, things were tight, people were ordering early. What happens if half of it gets canceled? What do I do? How do I manage that? And then what happens if the U.S. consumer, conversely, is okay? And, it turns out wages going up and deflation means consumers have more real income and demand picks back up. And all of a sudden we go from destocking the U.S. economy to restocking it again. So it's really a very dynamic time in the market. The last 2 years weren't very fun to be a purchasing manager, I don't think, across the space. And I'm not sure the next couple of years are going to be any less boring.
Indeed, so much going on. But it's just getting to the nub of the matter, isn't it? How should companies use this information in their strategies and investor communication?
Yeah, I don't expect, the key message, I don't expect companies to know all the answers. I think if you pretend to know all the answers, no one's going to believe you, honestly. But in that sort of world, I think the gut reaction of a lot of companies is to reduce the amount of information they say, take away guidance, make less communication more rather than more. And I think really the optimal thing to do is the opposite. When times get more uncertain, investors want to be reassured. They want to hear companies' thoughts. They want to have some guideposts with which to base their expectations, right? Now, we know you can't predict the future, so how do you do that in an uncertain time? I think the answer is you have to lay out what you think is a reasonable to conservative case of the future, and then just be very upfront and very explicit with the assumptions you're making. And that does two things, right? It makes it easier for investors like myself to adjust our earnings expectations, for example, real time as our view on housing starts or consumer retail sales or iron ore prices or whatever it is changes real time, right? And then it also gives you as an investor relations professional a means to talk about that as things change quickly without having to redo your entire guidance framework, without being hamstrung by not giving, not wanting to update prior guidance mid-quarter, things like that. It's a lot easier to say, hey, we assumed housing starts down 10. As you can see, the latest forecast was down 15%. So that's a little bit worse than was built into our base case forecast, if you will. The other thing I would just say is, if you're an investor relations professional, lean on us. Ask around. I guarantee you, it's my job, it's everyone's job here to have a view on these things. And if I don't have a strong view, if I don't have the answer, I can always point you to someone else within BAM who's, I guarantee you, we have an expert in whatever question you're trying to get answered. Because I do think what we're looking for as an investor in uncertain times is companies that at least appear to be on top of the current situation, not being surprised, have a plan, they're ready. And so as an investor relations professional, keeping up with the news and the latest and greatest that's changing, being able to answer any of these questions, like I said, the Chinese reopening has happened so fast. Staying on top of that is important because it makes you, as the face of the company, seem well informed and on top of what's going on.
Absolutely. That's very useful advice for the messages. I'm thinking about the medium as well. I mean, for IR teams trying to communicate during uncertain times, how valuable are virtual meetings for providing more frequent updates and transparency between you and companies in your portfolios? And where do you stand on the merits of virtual versus in-person NDRs?
Yeah, I think it really depends on sort of who you're talking to and the point of the conversation. So in terms of just keeping regular updates with investors, going through model questions, sort of the nitty-gritty day-to-day blocking and tackling of this job, I think virtual is great. It's fine. It lets you expand the number of people in the room, basically leverage some scale, makes your job a little bit easier. I think they're great. Where I do think in-person really shines is when you start to get things like the C-suite involved, right? When it's important to have more of a dialogue and an active conversation, when reading people's body language matters more. And I also think a lot of CEOs, CFOs, they end up on these positions because they have gravitas, right? They can really control a room and project and get your message across in person, right? Not trying to do that on Zoom, I think, is a lot harder. So I do prefer in-person meetings for C-suite or more strategic discussions, not just about modeling SG&A or something like that.
Absolutely. Good pros and cons on both methods. Thank you. Before we close, I'd love to hear your thoughts on the year ahead, 2023. What are your views on the general economic outlook, specifically on the impact of inflation and the likelihood and length of a potential recession?
So I'm focused more on the industrial and materials space, right? So I'm gonna tailor my answer to that. I would say from an industrials perspective, even though I think we go through sort of a destock slowdown period just because we had high inventories that we need to normalize, and order rates were probably a little excessive during the COVID time, again, because lead times had gotten so long. What I don't see is the sort of hallmarks of a large industrial recession on the horizon. Normally, when you're talking about, large capital goods, in a really strong environment, people will buy extra. We'll be selling more tractors than we ever had, more bulldozers. People are optimistic. They're adding to their fleets. Same thing with heavy duty trucks, like all automotive, all these things that normally in a big economic upcycle, people would be sort of buying above normalized or average demand. Well, this time, because of COVID, even though people wanted to do that, they were not able to because the supply chains were not there. Production rates were not able to ramp. So in some ways, that constraint sort of took away the real downside risk of a really bad industrial recession, at least, because we just didn't build up those excesses. So I'm not super pessimistic on the industrial economy, sort of medium term, if you will. I do think we go through a little air pocket, a mid-cycle slowdown sort of thing, but I do not have a super bearish view. And then, we have the China reopening, which a lot of the industrial materials space is quite levered to China at the end of the day. And so it's a nice little demand kicker, if you will, for the space that kind of differentiates it from a lot of the rest of the economy. So I am, call it modestly optimistic that the industrial economy at least can get through this.
Absolutely. We're hearing something of that too at our in-person events by IR Magazine and Corporate Secretary. Something of a different animal potentially coming up down the pipeline from, for instance, the global financial crisis. Not quite apples for apples, but we'll certainly watch this space. Fascinating. Thank you very much, Chris Weltzer, Portfolio Asset Manager at Balyasny Asset Management, for sharing your expertise with IR TV by IR Magazine.
Thank you, James.